At Sun & Swell, we sell healthy, sustainable snacks, all plant-based, gluten-free, delicious, but then packaged in plastic-free compostable packaging. We'd been using PayPal checkout on our website for years when we learned about PayPal working capital loans. Traditional financing is a very long and painful process.
They have a tough time understanding the entrepreneur, especially in the early stages. They look at things through a different lens.
But with PayPal, it was super fast to apply, and we received a response really quickly. Our first PayPal working capital loan was for $100,000. And then recently, we took out another $100,000. We used both of our PayPal loans for inventory.
I think that entrepreneurs who are moving quickly need access to cash without long cycles of dealing with banks and bureaucracies. I think that that's one of the reasons why PayPal was great. It's quick, it's easy, and you can just get back to doing what you do best.
The impact that we hope to have is for other companies to begin to realize they can build a snack food brand without plastic and ultimately pass on our knowledge to the broader industry.
Please welcome PayPal's Chief Financial and Operating Officer, Jamie Miller.
Good morning. These objectives guide how we will make decisions to maximize shareholder value, making it clear for our teams how keeping merchants and consumers at the center of everything we do can drive a great financial algorithm for PayPal. Our goal is to first grow volume faster than e-commerce, to lead with innovation, grow accounts and engagement, and to increase the penetration of our omni solutions, and to accelerate branded checkout. Second, it's to drive a high single-digit TM dollar growth by 2027 with an ambition for 10% plus longer term. We are prioritizing durable, high-quality growth, and that's supported by the key initiatives that I'll walk you through in a bit. We have longer-term ambitions to unlock new growth and high-margin opportunities. And third, we'll invest in innovation and leverage our cost base. We operate in a competitive environment, and it is critical that we stay on offense, and we still have room to be much more efficient and use our savings to fund reinvestment and drive operating margin expansion. Fourth, we'll deliver low teens plus non-GAAP earnings per share growth by 2027 with ambition for 20% plus longer term. And finally, our goal is to grow free cash flow in line with earnings while maintaining disciplined capital allocation. 1 year in, we're proud that we've returned the company to profitable growth. We have a lot more ahead, but in our first year, we grew revenue to $32 billion. We positively inflected TM dollars growth, growing TM 5% ex interest, accelerating 800 basis points over 2 years. We bought back $6 billion of stock, and we delivered 21% earnings growth. In underlying our financial results, we're making progress in key areas. We've accelerated our pace of innovation. We've brought energy back into the brands. We've returned total actives and PayPal consumer MAAs back to growth. And we just became much more disciplined across the organization. Braintree is back to profitable growth, and we reduced costs and reinvested hundreds of millions back into product, technology, and marketing. Looking ahead, we have a diversified portfolio to drive growth. And what you see on this slide is a more simple and relevant TPV breakout than in the past. It's a better way of how we think about the product portfolio today, our customer needs, and our use cases. And we're making progress across each of these areas. So the first, online branded checkout, includes PayPal branded checkout, eBay, and Pay with Venmo, and it's about 30% of our TPV. We have a clear plan and execution milestones to accelerate, and I'll talk about that more in a bit. P2P and other consumer includes PayPal P2P, Venmo P2P, and our branded debit cards. We're making product-led improvements. Both Venmo and PayPal P2P volume accelerated last year. Venmo exited the fourth quarter at 10% volume growth, accelerating by 2 points. PayPal P2P accelerated for the 6th consecutive quarter to 6%, and we've launched more in-person capabilities. And payment service provider, the third line, spans both large enterprise and SMB processing and value-added services. We're driving higher margins and deeper merchant relationships, and we've made deliberate, healthy choices within Braintree to shift from unprofitable volume, moving into higher SMB processing with PPCP and driving more attachment of VAS, like payouts and new solutions around FX and risk as a service. And then second from the bottom, you'll see branded experiences, which includes branded checkout online above, plus our offline debit. And the goal of sharing that is to help you follow our progress as we seek to form deeper consumer relationships and habituation across online and offline. And that's a trend that we expect to accelerate in 2025 and beyond. Moving to overall ecosystem health and opportunities to improve engagement, we're making progress across our consumer base, but there's still so much more opportunity ahead. Branded checkout MAAs went from stable to growing, up 3% last year, and we added 3 million more monthly active accounts using debit or buy now, pay later. Transactions per active are growing, and our goal is to drive more consumer engagement and a higher PayPal selection rate and accelerate our TPV. We have a clear set of financial objectives as we execute in 2025. Growth has accelerated, and we expect TM dollars ex interest to grow 6% at the midpoint of our guide, which is more than 100 basis points of acceleration compared to last year. We're guiding to high single-digit earnings per share growth at the midpoint, and that includes headwinds from higher taxes and lower interest rates, and we are well positioned to drive attractive double-digit earnings growth into the future. We have a clear set of strategic initiatives to drive durable, profitable growth. To win checkout, our new modern flow improves conversion and delivers a better experience to increase habituation and capture more share of wallet. And this has a halo effect across everything you see on this slide. We have momentum behind buy now, pay later, SMB, and consumer engagement. And with Omni, we are increasingly the way for consumers to pay for any transaction. For PSP, we have significant opportunity to improve and to grow profitably. And also notable next-gen initiatives that are small today, but we expect to deliver value over the medium to long term. And this includes personalization, ads, our commerce platform, and crypto. And each of the initiatives I just highlighted plays an important role. We expect to accelerate TM dollars growth ex interest, moving from 5% in 2024 to 6% at the midpoint of our 2025 guide, to a range of 7 to 9% by 2027. Longer term, we have a goal to drive 10% plus growth. It's ambitious, but it's what we want our teams to strive for. Scaling next-gen growth vectors, AI, personalization, ads, and crypto, all of that is part of what can help us get there. I want to take a minute and walk you through some of the specific goals and ways for you to track our progress underpinning each of the initiatives. And starting with checkout, which is at the center of everything we do, our new products, partnerships, and campaigns are all aimed at accelerating checkout. We want to be the easiest, the fastest, the safest solution, and it is essential we deliver more value to customers. And that means higher conversion for merchants and making things even more flexible and rewarding for consumers. This chart shows our path from 6% volume growth last year to at least 8 to 10% by 2027. Our strategy is underpinned by 3 key building blocks. First, modernizing checkout solutions to drive higher selection rates. Taking our latest branded checkout experience from about 30% coverage in the US today to more than 80% globally by 2027. Our goal is for these experiences to deliver more than 1 point of conversion improvement to merchants. But the real opportunity is how this impacts selection rate. Better experiences, less breakage, more retention, all lead to stickier, more engaged consumers and a higher share of wallet. Leaning into pay later. Our goal is to nearly double the size of our pay later business over the next 3 years, to grow at more than a 20% CAGR to nearly $60 billion, and accomplishing this through a combination of product and geographic expansion and a go-to-market focus on key merchants, verticals, and marketing. Capitalizing on Pay with Venmo, we will nearly triple Pay with Venmo volume over the next 3 years. We expect to grow at more than a 40% CAGR to over $22 billion. And we're starting to hit our stride. The Venmo team is winning in key mobile-first verticals. And compared to a year ago, our execution has improved, teams are focused, and we're accelerating. We have more work to do, but I'm really excited about our progress. We're expanding beyond e-commerce to become truly omnichannel. Within P2P and other consumer TPV, we accelerated 4 points to 7% growth in 2024, and we expect to maintain this momentum, growing to at least 10% by 2027. We have improved our core app experiences in P2P and mobile payments. We've launched more ways to pay in person, and we ran our PayPal Everywhere campaign in September, which is reshaping how consumers think about PayPal. Debit penetration remains a huge opportunity, and we're driving adoption. We've added more than 3 million first-time users. We're bringing card and NFC capabilities to several European markets later this year. And within Venmo and P2P, we're bringing in more users, driving product attachment, and increasing engagement. And all are areas that help us drive revenue growth. And we're focused on improving the overall profitability of our PSP business. And we're doing this through pricing to value and aligning our sales teams and incentives to profitable growth. Braintree TPV growth is lower in 2025 as we shift away from unprofitable volume, but TM dollars have accelerated, and we'll be in a position to re-accelerate TPV later this year. Growth is a combination of new verticals, international expansion, and more offerings to SMBs. We're rolling out new value-added services, including across FX, risk, and payouts, to drive more value. And we expect PSP to contribute more than a point to TM dollars growth this year, with more benefit over time. We continue to have a sharp focus on containing costs while reallocating to healthier levels of technology and marketing. By the end of 2025, we will have remixed more than $400 million into marketing and tech compared to 2 years ago. Our headcount was down around 10% each of the last 2 years, and we will continue to balance investment and efficiency. And we see further opportunity for efficiency over time, shifting the allocation of spend more into key areas like tech and marketing. And our goal is to drive down OpEx as a percentage of revenue as we leverage our cost structure. Now I'll take you through our financial outlook. As you've heard consistently, we are focused on accelerating profitable growth, moving from 5% TM dollars growth, excluding interest in 24, to a range of 7 to 9% by 2027, driving expense leverage, operating margin expansion, and share buyback combines for low teens plus EPS growth. And that includes headwinds from lower interest rates and tax rate inflation. And as I mentioned earlier, our long-term ambition is higher. We believe the opportunity in front of us is significant, and we want our team's ambition to be 20% plus EPS growth over time. We have a strong balance sheet. We have $15 billion of cash and equivalents, and we're targeting a balance sheet light model for credit. We have more opportunity to externalize parts of the credit portfolio. We generate a significant amount of free cash flow. We expect $6 to $7 billion of free cash flow in 2025, and we expect CapEx to be in the range of 2 to 3 points of revenue over the medium term as we modernize more of our tech infrastructure and data center architecture, really positioning our teams to move faster, better serve customers, and unlock data for personalization. Our number one priority is to invest in future growth, and we'll be disciplined in our approach. We'll maintain flexibility for selective M&A, but it's critical that we execute on what is already in front of us. Over time, we expect M&A to also serve a role, but we need to earn that right, and we will continue to return capital. This year, we have another $6 billion planned via share buyback, and we're targeting buybacks at about 70 to 80% of free cash flow over the medium term as we continue to evaluate other ways to return capital. So I'll wrap up by again showing you our financial objectives. We believe we are well positioned to drive long-term shareholder value. We have trusted brands. We have the largest two-sided network in the developed world, and a product and innovation engine that's accelerating. We have multiple ways to win, and I'm excited about our future ahead. And with that, I'll turn it back over to Steve.
Thanks. Jamie, appreciate it. Fantastic to see how all of those products, services, customer-backed thinking actually wraps into a financial algorithm that makes sense. In a couple of minutes, I'm going to invite all the speakers back up here to answer any questions you may have before lunch and the demos, again, that we have. As you can see behind me, they're getting the stage ready. I will ask this. Please raise your hands if you have a question. Lizzie, Allison, or Ryan are distributed, and we'll bring you the microphone. And I'd ask two things as you usually hear from me on our earnings calls, right? One is when you start, actually, please state your name and firm for the webcast. But then importantly, really, please try to limit yourself to one question to start. We will try and circle back to everyone once as many people have had a chance to ask questions as possible. So with that, please welcome back on the stage Alex, Jamie, Srini, Diego, Frank, Michelle, and Susan. And as soon as you're up, we will get started. Lots of hands. Yeah, I know. It's amazing how some questions can kind of come in. Okay, so wow, we have a lot of folks. Ramsey, why don't we actually start with you?
Ramsey El-Assal from Barclays. Thank you so much. A terrific day, a lot of great information. I wanted to ask, I saw a couple of charts on the screen today that had sort of escalators of customers or stakeholders who maybe had involvement with one product and other products and more products. Can you kind of take a step back and talk about how do you speed up that sort of escalation or graduation of your clients or your stakeholders from one sort of stage to the other? It's kind of a broad question.
Yeah, let me actually, Susan, I think, can I turn that over to you and have you think through that?
So I think we've created a playbook that makes sense to us now. We start by working customer back. What problems are they trying to solve? The meta set of problems are quite aligned with how we think about the future anyway. They want to grow their ads business, if we use them as an example. And then we lean into the places where we collectively can add value to help accelerate momentum and growth. We then, with our largest clients, often go into either a set of co-creations where we're looking to either embed or externalize aspects of their assets into ours to help effectively create differentiated experiences. But for our mid to longer tail of customers, we then take the set of platform, the assets that you hear, particularly on consumer, where we have several points of difference, and we take them, embed them, and let them serve them to their end customers as they will. We've also changed the way we work, right? If you look across the organization, we now have teams that are embedded in each of the key local markets, and those are full stack teams. We have consumer teams, small business teams, enterprise teams. We also have access to local eng. So all of that combined allows us to move much faster, not just in the ideation, but ultimately in the implementation and the curation and management of growth. It's an effective playbook. We know how to scale for mid-tier. We're excited about the opportunity we have with our very largest partners because through them, we're also innovating and creating new solutions that we take into the market.
I don't think I can overstate how different the mindset is now and how it's driving behavior. So before, we were organized around individual teams. We had individual teams with individual goals and individual products that they were responsible for. Even on the consumer side, we had individual product teams that if you looked at the PayPal app itself, you could almost tell where the lines of our organization existed. Because you would have one team that was focused on the debit card and was arguing, you could almost tell, was arguing with the rest of the team to figure out where the relevancy of the debit card would be. Versus now, the mindset of, we have a suite of products, let's work customer back, understand how we show up, whether it's for a merchant or a consumer, in a holistic way. And so that's where you're seeing our attach rates starting to go up, and that's why we've got confidence in bringing this together.
Harshita, why don't we go to you?
Hi, good morning. Thank you. Harshita Rao with Bernstein. So Alex, Jamie, I want to follow up on the 6% to kind of 8 to 10% branded TPV acceleration. You discussed a number of initiatives, the modern experiences, which will drive that. How do you factor in the competitive dynamics with respect to Apple Pay coming online, Shop Pay, other buy now, pay later, kind of factoring into your outlook? Thank you.
Yeah, it's a great question. And obviously, we spend a lot of time benchmarking ourselves versus competition. The first thing I'd say is we have to have a best-in-class experience for consumers. And that's what you saw today, which is, and I've been very consistent, if you go back a year ago, that branded checkout experience, particularly on mobile, as Frank walked through today, was enter in your email, enter in your password. It was very clunky. And our ability to now leapfrog competition and ensure that we have the best-in-class consumer experience is step one. But that is insufficient. I think if we are here 3-4 years from now talking about a frictionless checkout experience, we as an industry have failed. This has to now turn into a commerce experience. This has to turn into an experience where you as a customer are getting a personalized checkout experience, just like you saw on screen today, where I go into my store, I go to checkout, and I'm getting, in our case, a button that is speaking to me. It knows me, it's personalized to me, it's giving me the right reward, it's understanding the loyalty that I have with this merchant. That to me is a completely different experience. And I think we are the only ones with a two-sided ecosystem, with access to merchants at scale, with access to 80 million plus shopper profiles, and access to hundreds of millions of consumers on an open, agnostic platform to be able to deliver that next version of commerce. So we need to keep looking at competition. We need to get to best in class on the current experience, but we are focused on innovating for the future and being the leaders in the next version of commerce.
Tien-Tsin?
Thanks, Steve. It's Tien-Tsin Huang from JP Morgan. I just want to ask to accelerate branded checkout. Can you do it at the same economics that you have today? Is there still a price to value exercise to go through? Because you make the case that you're doing a lot of work on the consumer, give them a lot of choice, things like that. I'm sure if you unbundled that, there's an interesting exercise there. But I'm curious just about economics and take rate and ARPA, that kind of thing.
Yeah, let me start, and then maybe Jamie or anyone else pop in. The way I think about it is, again, if we change the game in how we engage with our merchants, branded checkout gets far more valuable for our merchants as well. So you're already starting to see things like habituation with buy now, pay later, right? The increase in now bringing buy now, pay later into the experience, the uplift it gives for merchants is also economics for us as well. But what we're starting to see is we're having merchant conversations, and I'm having many of these personally with CEOs of some of our largest merchants, is we are now able to bring them new customers. And so the people they're bringing into the conversation are their CMOs, are the people talking about customer acquisition. And so we're tapping into economics in the relationship that's beyond just their payments person or their checkout person. And so I just think, again, it's the biggest mindset shift that I asked you all at the beginning, and I will continue to ask you all to go through now, which is the evolution of a payments company that is just focused on creating a frictionless checkout experience, which we are still the #1 player in, into a commerce company. And I think it just taps us into much broader addressable markets.
Yeah, and to add to what Alex said, I mean, a lot of what we're doing around branded checkout, driving debit, driving buy now, pay later, driving pay with Venmo, these are all high margin products in addition to the habituation and other halo effect they bring to branded. And we see that halo effect in the cohorts and in the numbers. And so when you look at take rates, some of those do carry lower take rates, but they're margin accretive. And so margin will be accelerating over the time as we do this, but at the same time, take rate may shift based on product mix and things like that.
All right. Hey, Lizzie, do you mind going to Dan from Wolf? I gave you your intro.
Oh, it's Darren Beller from Wolf. Thanks, Steve. Guys, I just want to understand a little bit more. We've had great data on the checkout experience getting better, and you have such a great runway there, and how many monthly active users you have is really a differentiator. But how do we help us understand the steps you're going to take to convince the consumer, really light the fire under a consumer to say, from here on, I'm going to use Pay with Venmo. I'm going to use PayPal when maybe they didn't before. Beyond just the checkout experience getting better, something has to really, I think, ignite them. Help us understand the steps, marketing, loyalty, anything else that would be helpful to get. And where does that 34 transactions per month, or per year rather, where's that going to go over the next few years? Thanks, guys.
Diego, you want to? There you are. I'll find you. You want to start, and I'll.
Yeah. Let me go back to the point about the shift on the mindset, because we are moving from a value proposition that was only about checkout, meaning a button, to a value proposition about PayPal, which means we want people to stay, we want consumers to stay in our ecosystem because there is a much larger equation of value from them when they do more with PayPal. So it starts with checkout. As we were saying before, now we are connecting the rest of the products in the ecosystem to checkout like never before, from debit to pay later to pay with Venmo, even crypto now. And that is going to create not only habituation, but on top of that, we're also going to build rewards that are going to give you really a lot of reasons for you to stay on that ecosystem. And I said it very quickly during the presentation, but we are thinking on rewards because we are the only ones that can do it, that will really connect PayPal first-party rewards, not only on just payments, but the whole ecosystem. So you really get more for doing more with us. And then merchant rewards as well that will be merchant funded, connecting also through our smart wallet with the rewards program from our merchants. So when you put all of this together, you're going to get so much value as a consumer that is going to be really compelling for you to stay with us. On top of that, and you saw what we did last September, our marketing is also changing to, number one, help you think differently about PayPal. It's not just for some purchases or just for online purchases. It's for all purchases. And that is a massive change for the way the consumer thinks about PayPal, which in combination with the other things is going to allow us to keep you super engaged with our brand.
Just to add on to and pile on to what Diego was saying, I think the fact that we have both sides of the ecosystem gives us an opportunity to create completely differentiated experiences. We are consumer obsessed and merchant obsessed. I think there are other players out there and other platforms that actually look to, while driving customers, disintermediate the customer from the merchant because they actually want to own that relationship. We don't have to play that game. We actually can, if you look at that Commerce API, we can provide the merchant with the information to personalize the experience for that consumer and drive loyalty into the consumer's wallet because the consumer is engaging with us on a daily basis. And so when you think about a loyalty experience, I mean, everyone think back to the 90s when you had a thick wallet with a whole bunch of loyalty cards sitting in there. Those have gone away as you've now moved to a phone. But that also means that your relationship with your local merchant, your relationship with that loyalty platform has gone away as well. I think we have an opportunity to bring that back so that that consumer understands that, hey, this is where I make my purchases all the time, and this is where I want my rewards and my loyalty to be, and the merchant gets to have a deeper relationship with those consumers. And I think we have a very, very unique opportunity to create that flywheel.
Okay, let's come back to the front row. Allison, do you mind? Let's get Brian from Deutsche. I know some folks have flown in for today, and I appreciate that. We all do.
Thanks, Steve. Brian Keene, Deutsche Bank. Just back to thinking about unbranded and Braintree and the platform. How do you, it was really important. One of the great things you've done so far, Alex, is fixed, the profitability, that the pricing there. When we think about the platform going forward and you go maybe head to head against strong competitors like Stripe and Adyen, how does the platform able to grow at e-commerce levels, at profitable levels versus the competition? What gets you there? What's the differentiator drivers?
Yeah. Let me ask Frank to start with our value-added services and how we compete there, and then I'll add on with where we go from there.
Sure. So we've reset some of those relationships, as Susan said. And what we haven't capitalized on, really from a transaction margin growth perspective, as I said, is selling all these value-added services into them. So that is something we're right now super focused on. Then secondly, our front book, we're building out now an omni-channel front book, as I've said. And we're also going to be focused, on geographies outside of North America, especially in Europe, where we see more margin. We're under-penetrated. We're strengthening that also from a platform capability perspective. And we're going very targeted after verticals where we are under-penetrated. So I think Jamie said it, as I expect actually towards the end of the year, really seeing significant growth coming from the front book so that we're growing at e-commerce levels.
You all will hear a very consistent, it's sort of how I think about competition and how I think about playing in very competitive ecosystems. First, you have to have a best-in-class product. Like that's just the right to play. We have to make sure that we have an incredible processing product, which we do, and now incredible value-added services that we could go head-to-head with, and I believe we can win in a profitable way. But I much prefer competitive battles where we leverage our unique assets to play sort of unfair games. And the conversations we're having with merchants now, when we're able to bring our consumer ecosystem to bear, is something that competition cannot bring. We have 400 million consumers. And when I sit down with the CEO of a merchant and I ask them what their biggest challenge is, I have yet to have one of them say it's basis points on processing. They say, I need more customers. I need to drive more habituated customers to my products. And when we say, great, well, I have this incredible asset called Venmo. Do you want young, affluent demographics? How can we work together to be able to drive those customers to your platform, it's a completely different conversation. So we have to have best-in-class products, which we do, and we're going to leverage the assets that we have that are unique to compete in an unfair way.
Allison, you want to grab the mic back? I see James. We'll go to James from Morgan Stanley over on the end there, and then I'll get to the back of the room after. We'll come to you.
Thanks, Steve. James Faucett, Morgan Stanley. Chris, I want to ask and build a little bit on your last answer here. I think the vision that you present for engagement with consumers and how that can benefit merchants, et cetera, is really compelling. At the same time, though, you're really asking for merchants and consumers to share a lot of data that historically they haven't been willing to do, or at least it's been a bit of a hurdle for them. And so I'm just wondering, can you expand on those conversations with merchants and how you can convince them, like if I'm going to Nike, to share the shoe size that I wear so that if I end up at another merchant's website, et cetera, that they feel comfortable with that. And as part of that conversation, something that's has been important in the past but wasn't really brought up today is like, how does that then work within some of the third-party NFC wallets, et cetera? So kind of tying all those ecosystems together. I'd love to get a little more detail how you're thinking about that. Thanks, Chris.
Yeah. So first, the data is our customers' data, right? And they have entrusted us for decades now to make sure that their data is safe and secure, and that we have built up a reputation that stands for privacy. So step one is we've had to build over time and consistency a great relationship with our consumers. Second, we work customer back on what is most important to them. And you heard multiple times throughout today that what customers are looking for is a personalized experience, right? If you think about even just the examples that I shared at the beginning, showing up at a store and having to create filters. I mean, we've all experienced the opportunity of going shopping online and finding the right product, and by the time you get the filter down to your exact size, it's out of stock. And we understand how frustrating that is. To be able to, as a consumer, know when I show up that I'm getting a personalized experience with just the things that are right for me is a value to me. And I trust PayPal to be able to share that with merchants. Now, we are not sharing and taking specific merchant information from one merchant to the other, but we are enabling the shopper to build their own profile. And so that's where we start, and that is, again, the advantage that we have as the only player that has a two-sided ecosystem. As we get into an omni-channel world, we believe we'll be able to share that same information. That shopper profile should exist no matter where you are. Online, in-store, agentic, that is your profile, that is your data, that is your information, and we should be able to enable that on a device, online, anywhere you are. And you've seen us start to create relationships, like the one we announced this morning with Verifone, where we are now able to connect an online and an in-store ecosystem. So I think we're just getting started there.
Any other? Okay. So I promised to go into the back of the room. I'm going to reach as far back as I can. I think I see Dan Dolev in the back, Ryan or Allison.
Hey, Dan Dolev here at Mizuho. A great analyst day. Thanks a lot. Very ambitious, very good targets. As you were doing the plans, like, can you maybe lay out, from here until 27, what you were thinking, what can go wrong, and then the alternative is what would drive upside to those, kind of like those two sides of the coin?
Yeah, let me start, and then Jamie, if you want to, you're always better at what could go wrong. Let me just start with philosophy-wise, because I think we've been consistent in the last year of being, I think, very prudent when we put a guidance out. We want to make sure that our say-do ratio is very high and that our credibility is very high. So as we went through, even presenting 25, which you've already seen, our ambition for 27, and then our longer-term ambition, internally, we work very hard to make sure that we've got line of sight and growth algorithms of what we can get there. Now, we're also cautious in if we don't see it yet, we're not going to put it in. And so, again, that's just a philosophy of how we're building, of how we think about guidance, how we think about long-term.
Yeah, no, and I would echo that. I think we've been very thoughtful about how we've put together and constructed our view on our plan over the next 3 years. number one, I'd say we have multiple ways to win, and you probably felt that and saw that as you moved through this. In terms of the massive opportunity at Venmo, the significant opportunities we have to really scale offline and have that come back into branded, how strongly and deeply we feel about, our branded path here and driving that through multiple vectors. So I think multiple ways to win. We did plan assuming a consistent consumer environment, so consistent to last year. Obviously, you read the news like I do. There's always something happening every minute in the last few weeks to follow on that front. And I would say the other thing that we've been very, very focused on internally over the last year is really getting our execution muscle humming. And Alex talked about this and being tightly integrated and really having people on the field playing their role the way we need them to play it. And that is something that we've been accelerating every day, but that's something over the next few years that we're really seeking to drive and make better and better and better.
Okay, great. Tim, front row, back to the front row. We'll try to go back and forth. There's no shortage of front row questions.
This will teach everyone to sit in the front row going forward.
Great. Thank you, Tim Chiodo at UBS. So for the branded checkout disclosure, so now PayPal has, Pay with Venmo has been moved into that. It's a small part of the base, but it's a nice portion of the growth for branded checkout. So I was hoping you could talk a little bit about the plan for better merchant acceptance or further merchant acceptance of Pay with Venmo, that button. What's changed? What was different in the past, the hurdles? And then Jamie, you kind of alluded to it, but there's a different unit economic there. So if you could talk a little bit about the varying gross and net take rate for Pay with Venmo relative to PayPal branded checkout.
So maybe, Alex, if I start.
Go for it.
And then we can jump over to Diego maybe. So Tim, maybe I'll start with the last time we talked in December, which is the product is so awesome. And really there's so many features of Venmo and different things we've added over the last year that if you guys haven't used them, please use them because they're really delighters. But Pay with Venmo is one of those. And it is the easiest, most simple, delightful experience. But what delights me is that it also carries with it a nice high margin. And it's very consistent with our branded checkout margins there too. So Diego, you want to talk about merchant?
Yeah, and listen, we've been very disciplined and methodical. You heard me talk about the 5 steps. We actually talk about the steps because if we get all that P2P volume to get spent through debit and Pay with Venmo is the first step for monetization, and you saw how low our penetration is right now. But also is focusing, again, maniacally on this design target that we have, this young urban affluence. So when you look at Pay with Venmo, I mean, a great example is we just launched with JetBlue, for example. Some people said to me, it's like, wow, I was surprised about that because I thought maybe Pay with Venmo or Venmo was in general about small transactions in I don't know, market fairs in neighborhoods. And I said, yeah, it's that, but also you have this incredibly young, active, affluent audience that they also want to spend on everything else. So when you look at travel and entertainment, when you look at gaming is, for example, a category that is very, very active. So we see that happening, and you're going to see a lot more because there's the pent-up demand of our audience that really wants to use their balances to spend. So it's very exciting.
And let me just hammer home a point I made a little earlier, which is a year ago, our go-to-market team for Venmo was on a different floor in a different building. And they were working as hard as they could. But it's like having a startup competing with everybody else that's out there. Between Susan and Michelle and the rest of the team, we now have one go-to-market team that's able to talk to the largest number of merchants in the world and say, do you want maybe the most valuable demographic anywhere in the Venmo demographic? It's a much different conversation.
Okay, I want to hit this side. Then Ryan, I'm going to have you search for somebody in the back there that we might be missing. But Andrew, you want to go to Andrew, Allison?
All right, thanks so much. Andrew Schmidt from Citi. I wanted to dig in on the modern checkout experience expansion expected over the next couple of years, going from 30 to 80. Obviously, a big driver of the big driver of the brand and checkout growth acceleration. What are the biggest unlocks to sort of get that penetration? And then conversely, if there are hurdles, where would you expect to see them? Just curious in terms of both sides, sort of the pros and cons in terms of the growth there. Thanks so much.
Yeah, Frank, you want to?
Yeah, sure. So I shared we're at 30% in the US. We talked in the past about modern integrations. So on those modern integrations, we can just basically ramp the core features, meaning the new design, without the merchants to do anything. So that's what we're doing right now, scaling very fast. We actually see a higher potential because we have a higher share of modern integrations in international than in the US. that gives them the baseline. Now, additional features that I talked about, they would need to do work, but it's relatively light lift. So now we're coming to some of these very old legacy integrations where we're right now going to market. And we're basically, the pitch goes like that. We show them the old experience, we put it side by side with the new experience, and it almost sells by itself because it's so much faster. And then you show about the additional capabilities that you can do, bringing the customers everything that Alex talked about, that we're shifting from should we do it to how do we sequence all these things that we want to do together. And that's the big unlock. The fundamental thing is these products need to work. They need to drive conversion, and we do synthetic analysis by merchant, giving them the data so that they see what it would do for them. So it works for consumers, it works for merchants. We bring a holistic conversation to it, which makes it then easier. And Susan is working through all the big ones. Michelle is working through all the platforms, which is a big unlock for the SMB space.
And just to hammer it home, we have 15 years of legacy integrations, hundreds of different patterns. We have not been able to provide a value proposition as a reason for a merchant to upgrade. We do now. There is very clear, as Frank just said, in the conversations we're having with small businesses, with platforms, with enterprises, it is a completely different conversation because we can show them the data and show them the experience. We will get, and we have confidence that we will get to the numbers that we shared, and then we will deprecate the old experiences. We're not going to live in a world where we have 15 years and hundreds of integrations. We need to be on the best and the most recent integration because that saves us costs and it provides a ubiquitous, consistent experience for consumers as well.
Great. We are running out of time. Let's try to get another one in. Ryan, you have somebody in the back that I can't see?
Jason Kupferberg from Bank of America. Thanks for all the info today. I wanted to follow up on branded checkout. When do we start this path towards acceleration? We're talking about 300 basis points 2 years from now. When does it start? Is it late this year? Is it first half of next year? Talk about cadence. And then just in terms of geographic mix, our understanding right now, U.S. is growing a little slower than international. So does the bulk of the acceleration in the next couple of years come from the U.S.? Thanks.
You want me to get started, or do you want to go?
Either way.
Go for it.
So Jason, let me talk about that in maybe two parts. The first is really thinking about margin dollar growth over the next couple of years, and then I'll pivot and talk a little bit about the U.S. From a margin dollars perspective, our guidance this year assumes 100 basis points of shift in margin, and certainly all the things I talked about are a part of that, and a significant part of that. Branded checkout, we're already at 30% penetration in the U.S. on the merchant experiences. All the work Diego has done around offline, debit, marketing, that stuff you're going to see us continue and be very focused on as we move through 25. So what I'd say to that is it'll be a gradation over the period of time is how to think about transaction margin. When we come over to branded checkout, the U.S. side of it, we are very, very focused on U.S. growth with branded checkout. It is something that has the full weight of the organization behind it. We have very, very strong market positions internationally. We expect growth there too and to continue taking share, but the U.S. is a big, big focus there. And Frank talked about the merchant experience as being a key part of that. The other piece of it, and I really want to make sure we make this link, is all of the things that we're doing offline, that habituation really does come back into more MAAs, better halo effect, higher branded checkout use, and the funds flow that works through the products. And that's both PayPal and branded. It's also on Pay with Venmo and how Venmo habituates the same way. So all of that comes into play there.
Any other? So we are actually out of time. I'm going to have to call it there for now on the webcast. And please do make your